Hello, everybody, and welcome to today's trading seminar. My name is Jose Blasco. Before we start, can I get a quick confirmation in the chat box that you hear my voice, sound is okay? I believe everything should be fine, but just in case. Anyway, so as I was saying, welcome to the trading seminar today. Today is November 6, 2019. And today we are talking about something extremely important, even though as a subject, if you wish, is not going to be the most complex subject of all subjects, but it is certainly very, very important. And it's one key reason why some traders, even though they do have a proper understanding of the markets, they actually struggle to find consistency in the results. Okay, so today we are talking about business. We are talking about trading as a business and how to approach, this particular activity that we love, trading the markets, like you would do with any other business, which is something that is not often done in this way, especially for traders that trade at a personal level. Many times, the business mindset is not always there. Okay, so we need to talk about this, and I'll be practical as we go through the session. Before we start, I wanted to just quickly introduce myself. I mean, I like to keep my introduction very short since we have limited time, and this training really it's about you, it's not about me. But my expertise is in the financial markets. I trade multiple assets, forex. I love it, obviously, but I also trade other assets such as futures, options, stocks. And apart from that, my background is in technology, so I develop technology products, trading apps, etc., etc. Okay, but anyway, again, as I said, let's keep my introduction short so we can dive into the subject for today. Before we start, as always, as well, we have a disclaimer, which is classical in the financial industry before any educational section. So I'll take care of the disclaimer very quickly, and then we start. The following videos, clips, demonstration are for educational and instructional purposes only. Tradictive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through demonstration do not indicate in any way the results you may receive on using our products. And this is the disclaimer, and therefore we are ready to start. So the session today, as you have seen with the title, it's all about looking at trading as a business. Okay, a couple of questions here. Have you ever found yourself spending tons of time practicing trading? Have you ever found yourself trying a methodology after methodology, looking for the perfect one? So when someone goes through this process of keep spending time mastering trading, trying methodologies, fine-tuning how to trade, many times the person doing that really gets to a level of proper understanding of the markets and even developing a proper methodology, but also many times still with all that knowledge, all that skill, all that set of tools, many traders are not finding clear ways on how to build consistent results or more consistency in the trading activity. Okay, so today we're going to be talking about why this may be, and most importantly, how to put some solutions into this classical problem among many traders. Okay, and hopefully the session again will be very helpful. At least this is my intention for you all. Now, trading as a business. Okay, trading is a business. So I mean, I think that's obvious, right? So we all know trading is a business. Okay, it's a money business. It's all about money. There is tons of money. We trade on leverage. You can make a fortune. Okay, so if I phrase it like that, and even if I don't phrase it like that, I think it's clear in the mind of all of us, trading is a business. Even if you approached trading as a hobby, okay, let's say you tell me, wait a minute, I own 25 businesses. I got 5,000 employees working for me. So, making income or producing returns out there, it's not a problem for me because I got plenty of profits being made by my businesses. So to me, trading is not a business. To me, trading is a little hobby where, every Thursday in the evening, I like to look at the markets for an hour or so, and it's fun and I love it. And that's trading for me, right? It's just a little hobby. So if you were to say something like that, I would take it, and again, we can certainly, as you can see with my accent, English is not my first language, so I'm not going to be defining what hobby means. Okay, we can certainly look at hobby from different angles, but I guess that we all agree that that hobby time, okay, that amount of time spent trading is still business time, because if you were to spend that hobby time like playing a video game where you don't mind or you don't care if you are being killed or not playing the video game, so then really you are not approaching trading as a business, you are gambling, which could be fun, and some people choose to do that, and I respect it. But at the same time, I believe that all of us in the room today, we are not having that mindset. We are looking for that consistent approach to trading, or consistent, or if not consistent approach to trading, at least trading in ways where the trading activity does produce some consistent results. And therefore, it doesn't matter if the amount of time you spend trading or is a lot or is little, then that business mindset needs to be there. I guess it's kind of obvious, okay, even though the problem here is that many times people don't realize they are running a business when trading. Example, and again, in this beginning part of the session, this is going to be very generic if you wish, but very important thoughts. Think about this, okay? And this may have happened to you. I mean, I'm sure, I'm pretty positive what I'm about to describe has happened to, you know, a collection of you in the session today. So think about this. Let's say you didn't know trading existed, and one day a friend of yours, a colleague in the work, approached you and say, you know what, there is this thing called Forex, it's amazing. Let me show you. And next thing you know, you look at it and you're like, oh my God, this is amazing. Let me try, right? And now you try and you make some money, you lose some money. So you get interested. And now what? You buy a book, you watch videos on the internet, you go take a class, whatever. And now you keep going and keep trying, keep practice. But what's the problem? It's all about putting an interest or a passion out there, and all about practicing without approaching it as a business, without a business plan, without some specific goals, without some sort of a guidance that leads you into where you're going. You're just basically, you know, just keep testing the waters or practicing just for the sake of hopefully develop some skill and hopefully make some money. But in the meantime, it's kind of like a discovery process. I'm not saying it's not right to do this for a little bit of time, but the problem is that most people going through this discovery process, okay, at least this is what I've seen myself with my own eyes, many traders with very good intention and a strong passion for trading, they stay in that discovery process without realizing that there is a moment in time where you need to switch from discovery process into treating this as a business, because this is the biggest business in the planet, and obviously it needs to be treated as a business. So still, most trading fans approach trading from a point of view where the focus is placed solely on adding practice and more practice to see what happens, hoping for the best. And again, that many times, actually, it's happening with a great intention. You know, the person putting time and effort with practice is doing it for a good reason, with a good intention. But again, if you keep practicing, and you don't have some sort of a structure into what you do, you are certainly not approaching trading as a business. It's more like, you know, you play cards with friends, it's fun, or you like it, or maybe you improve yourself a little bit, but you are not looking at this, you know, as a business again, okay? So we need to have a business mindset, okay? And I would like to explore a few more thoughts with you. Hey, Andre, and very nice to see you. I see your message right now. Hello, Andre. Very nice to see you. So a few thoughts, okay? Will having a proper cooking skill guarantee success as a restaurant owner? I mean, I know trading and the restaurant business is probably such a different thing, but think about it. Let's say you are the best chef in town. You have an amazing skill when it comes to cooking, and your food tastes amazing. Like everybody, you know, are just waiting you to invite them for a meal because it's amazing how you cook. Well, still, this does not guarantee you're gonna be a good restaurant owner, because running a business as a restaurant, of course, implies knowing food and how to cook, and recipes and choices and menus and many other things. But it also implies many other things. Maybe you need to know about taxes too. Maybe you need to know about the town or the city where your restaurant is. You need to know the neighborhoods. This has nothing to do with cooking. Okay? So trading is a little bit of the same. If the only focus placed on trading was to be developing a good trading methodology, of course it's critical, it's key. I mean, if you don't have a good methodology, forget about it. But my point is, even if you have the best methodology in the world, but that's the only thing you have, and you don't have other structural components in your trading activity that makes you approach it as a business, then you may be struggling and you never thought why. Okay, you know, I have this friend who is an amazing cook, and his dream is to own a restaurant. But my friend doesn't understand the implications. Okay, why? Because the only thing he has is love for food. Okay, so, which by the way, it's an amazing thing to have. But putting that on the side, you know, when running a business, we need to be very specific. We need to be very realistic as well, instead of being, if you don't mind me to phrase it this way, this is gonna be a little intense as a way to phrase it, but I'm sure you can accept me to say it. So we need to move away from dream into more of a realistic approach to running a business. Okay, this is how professionals we do, and this is the difference. This is one of the key differences between people that trade at a personal level, you know, trying their best, versus people that really make money seriously with a certain level of consistency. Okay, so it all starts with the mindset. Okay, when approaching business seriously and consciously, would you even start a restaurant business without a business plan, even if you were the best chef in town? Well, no, we said that. Okay, so trading is the same. Even if you have the best methodology in the world, it's not enough to have a methodology. You need to have a business plan for your trading business, because it's business. Okay, even if you trade 1 hour a week, it's still business. So no matter the level of skill, most trading funds are ready to trade without a solid plan, and this could be a key reason for problems. I mean, I could certainly ask you, and if you feel like sharing in the chat box or the Q&A panel, you can certainly share. If it's personal and you feel like not sharing, it's okay as well. But if I was to ask you who has a trading plan, and you were to type I do or I don't, you know, probably we would see, and by the way, this is a very serious community here with FX Trade, but still you would probably see that many people would type I don't. And again, I'm not saying you have to type it or you don't have to type it, because again, it's quite personal as a question, and I respect your privacy in this sense. But this is an experience that I have done multiple times when meeting groups of traders, and I have asked this question. And even though I think that all of us in early stages, when we have approached trading, all of us, I would say all, and I'm going to say all with capital letters, we heard in early stages that we need to have a plan. The reality is that most people don't. And the people that do may keep it in a drawer and don't follow it, or find excuses to not to follow certain rules. That by itself is a problem. And by the way, we talked about that, I would say a few months back, when we conducted another session. I believe it was the one that we did that was called Do and Don'ts in Trading. So we talked about trade plans and the importance of trade plans, but today I'm going beyond that. I'm not talking about trade plans, which by the way are critical and needed. I'm talking about a business plan, which is at a higher level, even at a higher level than the trade plan, okay? And thanks for your honesty, Andre. Very nice to see you type, because again, it's sometimes it's difficult to acknowledge that fact. And also I understand that maybe some of you started learning how to trade maybe last week or last month, and therefore you have not had the time yet to have that some sort of a structure, some sort of a document. You're still in that discovery process, which is fine. But there is a moment in time you'll have to switch. Okay, so you need to become aware of that. So business approach. Okay, so what does that mean? Well, while a rule-based approach to trading would produce consistent action capable of leading to consistent results, planning for a trading business goes beyond trading rules, as I just said, and looks at other aspects of operating in the marketplace. A useful way to approach trading is to think of 3 different components. Component number 1 at the most generic level is a business plan. Component number 2, second level, would be a trading plan. And the third level, it's a trade plan. A trade plan is what you do in a one trade at a time basis. So for example, you are about to execute a trade now. So what are your rules for you to execute that one trade? Of course, you need a plan for that. You need rules. Maybe you look at the trend. Maybe you set a target. Maybe you look at whatever other parameters you have in your methodologies. Maybe you look at Fibonacci's, maybe you use some trading app, whatever. Of course, you need rules for that. But beyond the specific plan that you have per trade, you also need a more generic plan, which is the trading plan, and then a plan that envelopes everything, which is the business plan we are talking about today. So let me be a little more concrete. A business plan is easier understood if you think of a company with multiple divisions. Your business plan would impact the company as a whole. Some key areas to be defined could be allocation of funds or investments for that company or departments, business goals, okay, what are the different goals for that company, availability for time to trade. Now I'm getting a little more concrete with trading, isn't it? Risk management across trading accounts, okay, so you may have multiple trading accounts, you need a plan for the accounts, and then you need a plan for each account. Those are two different plans. Review process, accountability. So, you know, if you were to be this company, like think of a multinational company, I'm just gonna pick one randomly, like Panasonic, for example. This company produces lighting, produces fans, produces phones, produces air conditioning machines. So they may have different divisions, they may have different plans, they may have auditors looking at all those different divisions and plans and processes, but they also have an overall plan for what they want Panasonic to be. Okay, and this is just an example, and I'm being very generic up to this point, just to kind of open your mind to what the concept we're exploring today as we dive deeper in the following slides. Okay? So now, the business plan is looking at the company as a whole. Now, the trading plan, again, think about this company with multiple divisions. Your trading plan would refer to the plan for a specific division of such company. Going back to Panasonic, just to keep with the same example, maybe you are now looking at the plant that takes care of air conditioning machines, exclusively that. Okay, you are not looking at the other plant that maybe is building toasters or phones. You are not looking at that. You are only looking at the air conditioning. Okay, so you would have a plan for that. It would be very similar to the business plan, but more specific to that area. In trading, for example, you have a business plan for Forex, and you have another business plan for futures. That could be the way to do it. So you have a business plan for all your trading activity. Let's say you trade Forex and futures both. So you have a business plan for all your trading activity, for all the assets, all the accounts, all the everything. And then you would have a plan for your business for Forex and a plan for your business for futures. And then you would have a trade plan inside Forex and futures, if that was your case. Then you will have a trade plan. Or actually, you can even have multiple trade plans. Maybe you trade 2 different methodologies in Forex and 3 different methodologies in futures. So you would actually have 5 trade plans where each plan falls into every one of those divisions, okay? And of course, fall under the umbrella of the company as a whole, okay? So think of a company with multiple divisions again. Your trade plan would describe a very specific process that takes place in a specific division of your company. In companies, normally companies that run industrial processes, and I love to think about trading like an industrial process, because what is the ultimate goal? Consistency. So how do you get consistent? You need consistent action, because consistent action drives consistent results. As you may have heard me say before, random action would typically give you random results unless you get lucky and now you're consistent, but it's because of luck. And if that's the case, luck does not last forever, right? So again, coming back to what I said, we want consistent action. So think of an industrial process, okay? And one way on how I like to think about this is as a flowchart, as you can see in this picture, which is just an example, which, by the way, a few weeks from now, we'll get together again in another trading seminar, and I will be diving into how a trade plan should be. And so we'll dive deeper into the do and the don'ts on the trade plans and the different components of a flow chart. And, you know, we'll dive deeper into more detail into the trade plan itself. But today I'm not talking about that. I'm talking about the generic business plan, right? So I'm briefly describing the trade plan just so we are focused on which area of the business or the company we are talking about. So your trade plan would describe a very specific process, as I was saying. It would be made of a collection of specific techniques, tools, rules that when followed, they would either validate or invalidate trading opportunities. So you take it or you leave it, right? And that's it. And now you become a mechanical trader in futures or Forex using a specific time frame or another time frame on leverage or without leverage, with stops, or you know, with other contingency measures in case the market goes against you, with one target or two targets. All of these are the technicalities of your methodology. Again, one more time, most traders are loving spending a lot of time fine-tuning this part of the business, which is critical, but they don't think about trading as a business. So they don't talk about the generalities I was talking about before, which I want to go back to, so you understand what I'm doing. Okay. So again, one more clarification about the trade plan. Okay. Here's an example. So, and by the way, I'm gonna go into 4 examples of trade plans very quickly. I'll start with intraday, and the reason why I'll do 4 is because one will be intraday, the next one will be swing, the next one will be position, and the next one will be long-term investing. And I want to talk about those 4 because if you remember, let me go back just for a second, a few slides. We talked about that in your business plan, one of the components would be availability for time, okay, which has a lot to do with the trading style you perform. And the trading style, by the way, has to do with the trade plan. Okay, so of course, in the end, it's all connected, it's all related. Going back to the example with Panasonic as a company, Panasonic cannot have a plant to produce air conditioning machines, and therefore they would not have a plan for that unless they have the expertise on how to build air conditioning machines. So your trade plan is the expertise that allows to actually build a company. Okay, so that's why I want to go over 4 examples, because then it will help me to dive deeper into to going back to the generality of the business plan and go deeper into those concepts. Okay, so very quick, let's go over those 4 slides quickly. So here we have an intraday plan. I'm using here in the bottom part, and you have seen me use this in prior sessions, so I'm using the same techniques. So that way I don't need to spend much time explaining it. I'm using an app called AutoClimate. AutoClimate tells you if you should be a buyer or a seller or not to trade. At that moment in time, AutoClimate is giving you blue color, which means that you are expecting the market to go up. Of course, in this group, everybody has different techniques on how to trade. So that's why I'm using 2 simple, easy to understand apps. So that way you can understand my examples quickly. And certainly if you would like to use those apps, you are welcome to do so. You can see a few notes in the bottom part of my screen on how you can get access to those apps, okay? But again, I don't want to get into this now. So AutoClimate is telling you at that moment in time for the US dollar Japanese yen in a 60-minute time frame. So this is intraday, right? So it's telling you time to be a buyer. So what would you do? You would look at a lower time frame. In this case, I'm looking at the 8-minute time frame. If you look up here, it says 8. Okay. So 8-minute time frame combined with a 60-minute time frame. So this is the trading methodology using 2 different time frames, right? And what am I doing on the upper part? I'm using another app, Auto UFOs, which is telling you which is the right price for you to buy and which is the right price for you to sell based on identifying on-field orders to buy and on-field orders to sell. You may have seen me use that in prior sessions. So what would you do? Plan a trade with an entry, a stop, and a target, and that would be your technique. And if you did so, the climate propagated as expected. You bought at 106.95, you sold at 107.09 in this particular example. So you would have made 14 pips in 2 hour plus. Now, let's pause for a minute, because here's why I'm looking at a specific example here. When talking about business plans, as we will see in 4 slides from now, and as we have seen a few slides ago, one of the components of your trading plan is capital allocation. So in this case, for example, we are allocating 2 lots into the trade. So the amount of capital being used in the trades does not necessarily depend on your trading techniques. But of course, some trading techniques may not be able to be executed unless you have certain capital. So that is the point I was making earlier. Panasonic cannot produce air conditioning machines unless they have the expertise. Now, if they were to have the expertise on how to produce air conditioning machines, they would have an industrial process on how to produce those devices with high quality, meeting the ISO 9000 rules and everything to assure quality. But in parallel, Panasonic as a corporation would have a business plan that would plan for air conditioning at a higher level as a company. Okay, so this is where we are combining a trading technique in this particular case using two apps, Auto Climate and Auto UFOs. This is just the expertise. This is the trade plan. We are combining these with other parameters such as the availability for time to trade. So the person who took this trade in the business plan should have decided to have 2 hours available to be able to execute. Okay, so let's say you don't have 2 hours available, so then this trade is not for you. You don't have the expertise. You may have the expertise, but because you cannot implement this particular industrial process, it's like you didn't have the expertise, so you cannot run this business. Okay, we'll take a look at other slides to see what other businesses you can run, but not this one. Okay, or the amount of funds. In this case, this trade is taken with 2 lots, which with 100-to-1 leverage implies $2,000. Let's say you have this capital. So if you have this capital, go ahead and take the trade. Let's say you don't have the capital. Well, I mean, with Forex, the beauty is that you can use, instead of lots, you can use mini lots or micro lots, and you can make the trade smaller and you can scale down and take the trade still. But with other assets, maybe you cannot. Maybe you would have some required capital or required margins that you will need to meet. Okay, so there are certain things when you plan for a business, which is kind of like the problem of the egg and the chicken. What goes first? Learning how to trade and have a skill. So you trade, or having money, or having time. So you need all. You need time, you need money, you need a skill to be able to trade. What goes first? Well, it depends on where you are at. You know, certainly if you don't have the skill, then you cannot trade, even if you have the money. Okay, but now if you have the skill but you have the money, then you cannot trade either. Well, but if you have the money, you have the skill, and you were to prove, let's say with a paper money account, that you could produce consistent results, probably you may find investors that want to give you some money under management, and now you can trade. So again, what goes first? Well, it certainly depends, right? But I'm willing to use those examples to get you thinking about those parameters, because sometimes, okay, and now I'm going to have another statement here. Sometimes some people actually start trading the wrong assets. Okay, so let's say, for example, the asset you should trade instead of Forex should be cryptocurrencies, or the asset you should trade instead of Forex should be futures, or instead of, maybe you open an account with a broker because a friend of yours recommended you that broker, and the account you open to trade is an account to trade full lots in Forex, and you don't have capital enough. Maybe you should have opened an account that was a micro lot account or a mini lot account, okay, but maybe you didn't know because you opened the account before you got the skill. Okay, so again, what goes first, the egg or the chicken, right? So we are talking about all of this. And if you think about it, a lot of those problems are easily avoided by planning, like you would do with a business. So let's say you are Panasonic and you produce air conditioning machines, but you have never sold in a country such as, I'm just gonna pick a country, random country, Vietnam, for example, which I mean, for sure, Panasonic is running business there already. But let's say you are not there yet. Okay, well, before you establish yourself, wouldn't it be smart to hire a consultancy firm, you know, some consultancy lawyers, and get informed on the local laws to do import or exports and finding out everything related to that industry before you establish the business? So it's kind of what I'm saying, okay? So it's all linked, it's all related in the end. Maybe you are selling air conditioning machines in Vietnam and you need them to be only cold if you sell them in the south part of Vietnam. But maybe if it's in the northern part of Vietnam, it's actually quite cold on the winter. So you will want your air conditioning machines to do cold and heat instead of cold only. I'm just making this up as we go, just to illustrate what I'm trying to say with an example that really I just made up, okay? But hopefully it helps. So anyway, so let's go for example number 2. So let's say you tell me 2 hours, this trade took 2 hours, but I cannot stay 2 hours in front of my computer. Well, maybe another way to approach it is to do swing trades. Okay? With swing trades, instead of looking at the 60-minute time frame, you would be applying auto climate to the 4-hour time frame combined with another time frame, for example, 21. Well, still, you may say, wait a minute, 21 minutes, 240 minutes, this is still intraday. And it's true. But at the same time, maybe you do have a job that even though you are not able to stay in front of your computer for 2 hours straight, maybe you actually have flexibility to every 4 hours take a look and see what's going on in the market and re-update yourself when it comes to what's the climate in the market, if you were to use climate, for example, right? And then plan a trade where you expect the climate to propagate down and enter this trade, like in this example, again, using the same tools, auto climate, auto UFO, and you have sold at 132.32 and then collected a profit at 131.43. Again, these are just examples to talk about it. This would be a 4-day trade. So, well, how can you cannot, for sure, you cannot stay awake 4 hours in front of your computer. 4 days with no sleep in front of your computer. But you could certainly use technology to take care of your trade. Maybe you use bracket orders, okay? Most trading platforms allow you to enter orders with entry and then a stop loss and then a take profit order, isn't it? So this is known as bracket orders in the industry. So maybe you are using such technology, which is available in 99.9% brokers, isn't it? And now, you know, every 4 hours you look at the market, you place your order, get filled, and now let the trade happen. If you get stopped out, it's fine. If you get to your target, it's fine. It took 4 days. That's it. That's what it took. Sometimes it's going to be 4 days. Sometimes it's going to be 1 day. Sometimes it's going to be 5 days. But now you don't have to be doing intraday trading. You don't have to be so active. You don't have to spend so much time in front of a computer. And now maybe you make your trading compatible with your life or your availability for time. This has nothing to do with the methodology you use. If you think about it, this slide is exactly the same methodology as the one before. Same story. The only thing that changed is that I changed time frames. And this has an impact at a business level. It's like instead of running a business where you have a store and you open, you know, 10 hours a day, so now you have a store where you open 1 hour a day. Okay, and by the way, the 1 hour a day you open is, you know, every now and then, you know, not open all the time. So you make your business to be more flexible, to be more adapted to you. And of course, you still need to decide how much money you will use for the trade because you have margin requirements, all that stuff. But here, what I'm really talking about is the different time exposure. Just like if we go for the next example with position trade. Okay, and I see a few questions there. I'm coming to your questions in just a second. Okay, guys? So if I look at position trade, I'm doing the same thing here. Okay, just to keep it equal. Same industrial process, same methodology, auto climate combined with auto UFO. But what I'm doing now, I'm using the daily time frame combined with the 55-minute time frame. Now you look at the market every 1 day to check the climate. Now that's even for the even more busy people. Now maybe you look at the markets over the weekend, okay? And then the trades execute throughout the weekdays. So it's important to plan properly like that because it's very common, okay? I've seen it many times, for me to phrase it today, that some traders learn a methodology from a book, for example, and it's a good methodology. Let's say that's the case. But then the methodology has you trade the 10-minute time frame or the 15-minute time frame, for example, which is a good time frame to trade. But maybe that's not compatible with your life. And now the trader struggles to keep up with the trades just because you are following a methodology. So you are focusing on the trade plan, but you never thought about the business plan, which has you define how much time you have to trade. Okay, so those are important things to think about when trading and has a lot to do with success or failure, okay? So this is a trade that took 2 weeks. That's a very relaxed type of trade, okay? The technique, the trade plan is the same, okay? But the implications in the business are totally different. Or this one, okay? This one is an example where we are looking at the monthly time frame, applying auto climate to the monthly time frame, going into a 377 time frame for auto UFOs, finding the buy orders where to buy, right? And then when the trade executes and the climate propagates, okay, it goes from 875 to 9 point something. So this is a trade. By the way, this is a unique currency. This is the US dollar against the Swedish krona, which is a very low dollar pip currency. So that's why it's so many pips, 9,000 pips. Okay, so don't be impressed by that number because it's really very small pip value for that number. but still, from a business plan point of view, this is an 11-month trade. Okay, so let's say you tell me you are this guy I was talking about earlier. You look at the markets once a week, Thursday evening. You like to look at the markets 1 hour. Well, this type of trade would be fantastic for you to run if you were to be that type of profile. Okay. Okay, so now let me get the repeat of what I said before here. Okay, some of the key areas to take a look at are allocation of funds, business goals, availability for time, risk management, across trading accounts, review process, and accountability. I want to dive a little deeper into all of this, but first I'll take your questions here. So let me see. Do you know, Andre, do you know already when this trade plan webinar will be? That will be, I don't remember the date by heart, okay? But if you look at the FX Street web page, you get into the registration page for today, for example, and you click on my name, you will get the calendar of when that will be. I know it's going to be beginning of December, okay, but I don't remember the date exactly. Yes, and Paul, it seems that I read your mind, okay? It seems that I read your mind, and here is the components of the business plan one more time, okay? So now let's go one at a time, okay? Let's go one at a time. So first, allocation of funds. Defining the amount of capital to be used in trading is important. As a rule of thumb, the more money available, the more money to be made, but it may not always be the case, okay? Think about this for a minute, okay? And again, we need to define that. Very often, when traders open a trading account with a broker, people will be like, okay, so I'm going to fund 5,000, I'm going to fund 200, I'm going to fund 50,000. And that decision is quite random. We need to think about this from different angles. Example, let's say you have a trading plan with risk management rules that suggest that in Forex, you're going to risk 1% of your account per trade. Let's say that's your case. And let's say your account is 5,000. So how much is 1% of 5,000? Well, that's $50 if you trade in dollars, okay? Or 50 pounds, 50 euros, whatever the currency. So let's say $50 is your number. And let's say you took 3 losses in a row. So how much is that? 50 times 3, you just lost 150. Let's say you take 2 more losses in a row. So that's 5 in a row, nonstop. That's not a pleasant feeling, but it could happen, right? So you just lost 5 times 50. That's $250 of loss. And my question to you is, could you survive $250 of pain? Of course, it depends on the size of your account, where are you at, etc. Let's say the answer is yes, okay? Which I believe, it's not unreasonable to say yes, okay? But again, everybody is at a different level and it's all to be respected. But please bear with me on that. Let's say the answer is yes. Now, think about, you keep trading like that, and let's say you're doing a very good job, and even though you took 5 losses in a row one time, okay, then you start making money, and then you lose a few times, and then you profit a few times, and you keep going. And, after some time trading, your account went from 5,000 to, let's say, 50,000. Now, you're still risking 1% per trade, but now your 1% per trade is not 50 anymore, is now 500. So now what happens if you lose 5 times in a row? Well, now if you lose 5 times in a row now, you don't lose 250. You lose $2,500, which is 5 times 500. So can you take it? Can you go through that pain? Are you okay with that? Or are you going to get paralyzed? Well, the answer probably now is more diverse. Some of you may say, okay, I'm still okay with that. Some of you may be like, wow, that's taking me way too far out of my comfort zone. Some of you are like, no way I'm going to take that pain, right? So everybody will be at a different level, okay? Now, again, bear with me on that. Let's pretend you tell me, I'm okay with that. And you keep trading, and you have a good method. And it's just that it happens in trading. You may get 5 losses in a row. It happens. So let's say that happened to you, but you keep trading, and then you got profits, and then you got losses and profit and losses. And then let's say a few years later, your account is not 50,000, is $500,000, which is 500,000. And you're still risking 1%, okay? But now 1% per trade, okay, it's $5,000. So it's okay, it's still 1%. If we were to be computers, if we were to be robots, it's 1%. It's not a big deal. But what if you were as a human? What if you were to get 5 losses in a row? Well, now you just lost $25,000. And again, my question to you is, can you take it? Or would you get crazy emotional? Would you just give up on trading? You know, how would you be able to go through that experience? And that's why, as a rule of thumb, the more money available, the more money to be made. But at the same time, it really depends on the mindset of the trader. And this is something that is not often thought about when funding a trading account. Okay, so make sure you look at yourself in the mirror and you ask yourself in a very honest manner that question. Okay, well, if I was to lose 5 times in a row, how much pain can I take without getting emotional? Okay, and that could be one good way, one way that makes sense on how you define how much money you want to have in your trading account. Okay, instead of just allocate funds, you know, just like, you know, I want to make as much money as possible, so let's fund as much as I can. Well, yeah, you have all that money there, but if you were to use it all, you may not be able to handle it when you take losses. Again, as you grow experience, then maybe yes. If that makes sense. And even if you grow experience, we all have a psychological limit because we're human, we are not robots. Okay, after a certain level of pain, you start feeling it's too much. Okay, and this varies for all of us because some of us in the room may be not risk averse at all, where some of us in the room may be very risk averse, where some of us in the room may be somewhere in between. Okay, so it's a matter of trading psychology. Okay. Another aspect about allocation of funds is that some assets are traded on leverage where others are not. So of course, if you trade assets with no leverage, for example, stocks, then you need more money, or cryptocurrencies. You need more money because there is no leverage. Most assets have minimums, which may dictate the amount of capital to be funded, okay? Or maybe not assets, but brokers may say, hey, for me to take you as a customer, the minimum is whatever, 2,000, 5,000, 10,000. So that depends, right? And that may set the allocation for funds, okay? Different trading accounts may be specific to assets, and these requirements dictate the allocation of funds across accounts. So if you have a futures account, a Forex account, and a stock account, so you need to ask yourself all those questions to decide how much money to place in each account instead of you know, I feel like I'll do 5,000 for the Forex account because the broker said, you know, 5,000 is good. So, you know, again, some of you are certainly way beyond that level and you know exactly why you have the amount of money you have in your accounts. But for the ones that you are beginning in this industry trading, you know, you may have quantities of capital in your account which are far too low or far too high. And you need to ask yourself those questions. Okay, so this is a business question. This no matter the trading plan, no matter your trading methodology. Okay, you need to think about that. Quick example here. Okay, quick example. So this is SPY. SPY is an ETF. An ETF is like a stock. To trade that ETF that represents the S&P 500 index, you need to come up with cash. There is no leverage. So let's say you bought using auto UFOs below, and this thing went up, okay, rocketed up. You bought at 305, that was the price set by auto UFOs, like the prior examples, and you sold at 306.18 because it's the time when the market closes and you don't want to expose yourself to overnight risk, so you closed right before the close. Let's say that's the case. That's the case. If you did this trade, you made 0.33 cents. Let's say you purchased 1,000 shares of SPY, so you made $330 of profit in 15 minutes. Now the question is how much capital you need for this trade. $305,000 is what you need for this trade. Why? Because the ETFs, being a cash product, implies that you need whatever amount of money is the price times whatever amount of money is the size. That's the amount of money you need. Okay? There is no leverage. Okay, so in other words, you would have made 0.11% return in 15 minutes. I mean, if you do that every day at the end of the year, it's quite nice, actually. I'm not saying that's wrong. But what if you traded the same market with futures? Okay, so this is the S&P futures, tracking the same S&P 500 index, same story. You expect it to go up. Why? Because you have auto UFOs there, plotting a zone, slightly different price level. Okay, but same story, price went up from there. You would have bought at 3,061.75. You would have sold Y before futures closed at 3,064.75. Futures close 1 hour per day. Okay, futures markets in the US trade 23 hours per day. Forex is 24. And In this case, you would have made 3 points. Every point in the S&P is $50. So let's say you would have traded 2 contracts. 2 contracts times 50, it's $100 a point. So you would have made 3 points times 100. That's $300 in 15 minutes. That's 6% return, because when you trade futures, you trade on margin, you trade on leverage, just like when you trade Forex. With most brokers, you will need way less than 5,000. I'm just using a high number to be pessimistic. So if you make 300 out of using 5,000, that is 6% in 15 minutes. Well, if you look at the difference between 6% and 0.11, I mean, it's a huge, massive difference. Not only that, from a business planning point of view, you would only need to allocate $5,000 in your account instead of $300,000. Okay, so again, all those understandings and decisions need to be made in parallel of learning a trading technique. Those are things that go in parallel. Okay? Often, people learning a trading technique, they apply it to a time frame that may not be the time frame they need. That has to do with time availability that we need to talk about again. But also on top of that, they found X amount of money in a trading account based on whatever recommendation from a broker, which may or may not be related with, the goals of that trader, which we haven't talked about goals yet. We need to. And again, it's all those decisions are business decisions that often traders don't think about. And then they wonder why there is lack of consistency. And maybe they use a good methodology, but all those other parameters are not in the right place. It's like you are Panasonic, you are building air conditioning machines, and you have way too many employees or way too little employees in that plant. Okay, so again, all those things need to be planned properly. So setting business goals is important to understand if the business is doing well or not. Okay, the goals should be realistic. That's another story. Sometimes people open a Forex account, let's say with $200, $500, and the expectation is to produce $10,000 a month. I mean, while this is doable from a mathematical point of view, I can do the math, I can write it, and it works. The reality is that not many traders in the world produce $10,000 a month with $500 accounts. I would argue that this is close to impossible in a consistent way. Again, that's just me, okay? Maybe some trader is capable of doing that, but I have not seen it, at least not consistently. I've seen people do that 1 month, but not the next. So again, we need to shoot for realistic goals. And it's important to have realistic goals, because if you trade with realistic goals, then you'll trade relaxed. If your goals are not realistic, then they are not achievable, and then you will always be stressed out, taking extreme risk in the marketplace in order to reach goals that are not possible or not achievable or not realistic. So those goals have to be realistic. And in a minute, in the next slide, I want to talk about how to set those goals. Because again, most people plan the goals out of idealistic wishes. It's like, I hate my job, but currently I make whatever, $10,000. So let's open a Forex account and I wish to make $10,000 so I can quit my job. Well, that's a fair wish. It's too idealistic. And again, without more proven facts where you can prove that you can produce those results and that you have the capital enough to produce the results, and you have, all the other components of the plan, again, it's kind of like a dream. And even though it's fair for all of us to dream, and we all have the right to dream, and like the beautiful movie with Will Smith about the pursuit of happiness, never allow someone to tell you that you should never achieve your dreams, okay? Which, I'm okay with that, okay? And certainly I'm up for that and living a life to the fullest extent. While I'm up for that, I've seen way too many people have unrealistic dreams, unrealistic goals, and take unnecessary risk and blow an account and do it again and blow another account, and after blowing 2, 3, 4 accounts, then give up on trading. And it's a shame, because trading can be your dream, but as only if you approach trading with the respect that the markets and the other traders in the world deserve, because we all trade against each other somehow, isn't it? And we all need to respect the other professionals in the marketplace. Like in sport competitions, if you don't respect your opponent, you probably end up beaten. Okay, so we need to be realistic. Okay, I mean, I'm using a little bit a collection of strong words here, and the last thing I would like to do here is to discourage, okay, anyone. Trading is amazing. Okay, I was an engineer, and I changed my profession, and I became a trader, and I love it, and I would do it a million times. So that's the last of my intention. But one of the reasons why I got to a right place is because I got good guidance into being realistic. Okay, so it's important for you to plan. So goals should be set by calculating the expectation of your trading methodology for a given amount of trades to be executed with a specific amount of capital. So goals should not be what you would like it to be. Goals should be something that you plan for. Let me get into the next slide and you'll see. If the goals were not to be met, apart from acting on the methodology itself, traders could decide to trade more or less, or use more capital or less capital to meet the goals. So in other words, maybe you have a good methodology and the only thing you need to meet the goals is to add more money, or to trade, instead of one trade a day, take 2 trades per day. And now you would get where you want to be. Again, you cannot do any of this unless you do what I'm about to show you on this slide, which is about expectations. So as a trader, and now we are back to expertise, which is what I told you earlier, that business plan and trade plan, even though they are in the extreme opposite side of planning, they are related. It's like coming back to what I said a few times already. You cannot build air conditioning machines as being Panasonic unless you have the expertise of that, right? So as a trader, you cannot have a business plan unless you know your expectation. In other words, unless you know how expert you are trading and how much are you capable of making. And how do you do that? Well, you pick a trading methodology, you practice it in a paper money account or in a real account with tiny, tiny, tiny money, okay? At that time, you don't have a complete business plan, but at that time, your plan is not to run a business. Your plan is to get some statistical results so you can calculate your expectation. You take 50 trades, 100 trades, 30 trades, 200 trades, whatever that is, and then you can calculate what is your win-loss ratio, which is how many trades you win versus how many trades you lose. And then you can calculate what is your average reward to risk ratio, which is when I profit as an average, how much I make, when I lose as an average, how much I lose. And now you apply this and you come up with an expectation. Take a look. So let's say a trader has collected enough samples from a trading methodology and wants to know more about its quality. Let's say your resulting win-loss ratio after whatever, 50 trades was 48%. Let's say your resulting average reward to risk ratio was 2.1%, meaning that your profits were as an average 2.1 times greater than the losses, and your losses were as an average 2.1 times smaller than the profits. Let's say if that was the case, your expectation would be 0.48 times 2.1, which is 1.008. That's your expectation. And now, how can you plan for goals? Well, simple. Let's say you have time to take 89 trades in a year. Let's say that's the time you have available. You see, in the end, it's all related, right? Now I'm talking about time. Availability for time, that was another component, right? So let's say you have time to take 89 trades per year, okay? Which is like, let's call it a couple of times a week, a couple of trades a week. And as a risk rule, you risk 0.5% of your capital. In other words, if your account was $5,000, you are risking $25 per trade. Okay, so you use X amount of micro lots or mini lots, so when you lose, it does not exceed $25. Let's say that's you. After 89 trades, knowing that your expectation per trade is 1.008 and knowing that your risk is 0.5% per trade, then you know you are capable of producing 44.85% returns. Correct? So if your account is 5,000 and you produce 40%, okay, what does that mean? Okay, well, that means that you're going to produce, like, let's call it $2,000. So you will take your account of 5,000 and you will end up the year with 7,000. So now you know what to expect in a realistic manner. Okay, now you can plan your goals for the business and start trading with those goals. Now let's say you tell me, wait a minute, I'm okay, I love what you're doing, Jose, but $2,000 a year is not enough. Well, how do you fix that? Well, add more trades or add more money, right? And now you can meet your goals, but your goals are realistic based on something that it's based on stats, based on your own activity after a collection of trades that was a sample size that was great enough. Okay, and then now you are more in the realistic side. Okay. Oh, yes, I'm reading your message, Kingsley. I hear you, my friend. Hear you. Yes, Sibusiso, I'm reading your message as well. Absolutely. At the end, you will see my email, and you can certainly send me an email, and I will be more than glad to send you a copy of the slides. Absolutely. So time to trade. Let's keep going, guys, because we are close to the ending time of the session, so I need to accelerate just a little bit. So time to trade. The fact that trading takes time, combined with the fact that most people are really limited on time availability, is often the recipe for rushing trades, missing trades, and that leads to poor results, as well as opening the door, and that's the worst, to frustration. And why is that the worst? Because the moment you get frustrated, your emotions are going to be all over the place, and now you're going to get emotional, you're going to be in revenge mode, you're going to be trying to set targets which are not realistic because you want to, make up for the money for the trade that you missed, and things like that. Okay, so businesses decide and remain constant when it comes to their opening hours, right? So if there is a restaurant, the restaurant says that we will open from this time to this time, they do it like that every day, isn't it? It's not like, surprise, surprise, today we decided to close. Surprise, surprise, today we decided to open. That would not be serious. So as a trader, you may want to think about the same thing. It's important to define our trading times in ways where we can be consistent on when we trade and making trading compatible with our lives so we can trade with a relaxed mindset. Example, trade on the left. So using auto UFOs, take a look. If you look at the dates, that was earlier in October, that was a weekend. The market closed, and this is how the chart looked like for the euro in a 4-hour time frame. So what do you have there? So you have two of those green areas, green zones, identified by auto UFOs, where if the euro drops there, you have a high probability for the euro to go up. So over the weekend, while the market is closed, let's say you're a busy guy, so over the weekend, where you have time, you plan to buy there. So you place an order, and then the market came to that zone, I believe it's Wednesday, if I'm not mistaken. You didn't have to even watch it because you had a bracket order with a limit order to buy, with a stop loss and a take profit order where the red zone is. And this trade took, 2-3 days, whatever. Okay, and all of this happened during the week while the plan and the placement of the order was done over the weekend. Okay, so this is a valid way to trade, and that could be an example on how to make yourself very relaxed if you happen to be a busy guy. Or maybe you're like, no way, I need to be in front of my trades, and I have time, and I love to monitor my trades, and I don't have the personality or the psychology to let the market do its thing without watching it. I have to be there. Well, I'll make an extra comment here. The market is not going to do what you want it to do just because you're watching. That would mean that you have superpowers. So we also need to learn to let the market do its thing, because it's going to be doing it anyway, isn't it? But again, I could understand in early stages of a trader to have this kind of control freak mentality, which I used to have, maybe because as an engineer, we are used to have everything under control. Okay, so and trading is more about probabilities, and you need to get used to that. So maybe you are the guy on the right, okay, looking for intraday trades, and you need to be there at that precise time. Notice I'm using an 8-minute time frame on the S&P futures, okay? That's 8-minute time frame. That's gonna be a quick one. And now price went into the green, bounced until the red, you bought in the green, you sold on the red. That was a 50-minute trade, in and out, done, okay? And you had to be there. So again, time of the day, availability for time, you need to think about it. Risk management. Many traders have understood well the importance of managing risk, but often risk management is seen exclusively as something important that applies to the trade you execute now. And for sure it is important. Okay? For sure it is important, but what about looking at risk management policies that apply to different accounts? Okay? Different assets got different risk. Different assets trade at different times. So trade frequency and other parameters depend. And therefore, it could be very, very smart to have risk management rules where, for example, if you are in a trade and the market is about to close on Friday, okay, maybe it's okay to keep those trades often in the stock account because you have no leverage. But maybe in the Forex account, you have to close it because if you get a gap against you over the weekend, it's a gap times the leverage, it may hurt. Okay, so you may have rules of that sort. Reviewing the results obtained from trading is just as important as setting goals. Reviewing trading results keep us honest. Possible scenarios. Trader goals are achieved. Keep trading. Second, stable results, but you didn't achieve the desired goals. So you know your expectation. I'm back to what I said before, right? So what can you do? Maybe you want more trades. Maybe you are over trading. So because you review, now you know you should have less trades. Maybe different time frames. You realize you were too stressed out in your trades. You should use a larger time frame and do position trade or swing trades instead of intraday. Okay, maybe you are using too many currencies that are correlated. You should take one trade or two trades at a time maximum and not to use too many euro trades, too many pound trades. With the Brexit, it killed you because too many trades went against you at the same time. Stuff like that. You cannot know that unless you review, okay? Or worst case, you have unstable results. Well, review and enhance your log in order to identify the origin of the problem. Emotions, not following the rules, the time of the day at which you trade, the trade size, was it variable or did you keep the trade size the same? Then switch to paper money, get a new sample of data where the consistency is now proven and go back to trading. Is that making sense? All those things cannot be done. This is what you would do with business, isn't it? Let's say you produce this air conditioning machine and then when you get it in the market, it's not selling well, or the customers that buy it keep complaining about, it's not cooling enough. So what would you do if you were Panasonic, right? So same type of approach. Have a business mindset, guys. Accountability. Just like when companies are audited to identify weaknesses in their accounting systems, having a similar process is critical in trading even when trading at a personal level. So trading can be seen as an emotional game. It is indeed an emotional game. And therefore, an additional benefit of using some accountability tools is to keep the trading actions in accordance with the objective real-time market data and as well as the specific trading rules to be applied. If someone is going to review what you're doing, like what would happen in business, you are not likely going to break your trading rules. But if no one is reviewing what you do, because you are not looking at trading as a business, you are looking at trading like something you do, let's see what happens, then you may break the rules, then you are inconsistent, then you wonder why. Where if you know someone is going to watch you, maybe it's your friend, maybe it's your spouse, someone is going to review your trades, okay? Well, then you're going to be, for sure, following the rules, because if not, they will tell you, why did you do that, right? And then you will stop that, okay? So accountability tools should be part of a business plan, just like when company directors report company results to the company shareholders. You need to be audited, you need to be kept accountable, like businesses, okay? So we need to be business-minded. And here is an example, okay, and I will go through this slide at the speed of the light because basically the session is over. But here's an example of how you could log trades, the time, the date, the symbol, where you long, where you short, the quantity, the risk, the reward, the strategy you will use, notes before the trade, notes after the trade, pictures of the charts before and after the trade, grades, okay, trade grades, even notes that talk about how did you feel. I felt that this trade was going to be a good one. I felt this trade was going to be a bad one. I felt no confidence to take the trade because the 2 prior trades were losses. I felt overconfident because the 5 prior trades were profits. All those type of notes will allow you to then approach your trading as a business, review, improve, set goals, be kept accountable, etc., etc. Anyway, guys, simple subject today, very simple subject. At the same time, such a critical subject that many people sometimes, because of this huge passion to spend time in front of a chart, many people don't spend time to plan properly like a business, because this is a business, and end up getting in trouble in trading without realizing why they got in trouble. Okay, So guys, a couple of things. Please, my email, jb@predictive.com. Okay, so if you want a copy of the slides, feel free to email me. The webinar is indeed being recorded. Very good. More. If you want to know more about other stuff that we do when it comes to helping you with putting your skill in place, apart from the webinar we'll do next month within the FX Street community, you can also check out this other link, tradewithufos.com/action time, and you can also join a free workshop that we do there with additional information about this subject and more. I've been using AutoClimate in this presentation, okay? We are more than happy. We love the FX Street community, so we are more than happy if you want to have access to AutoClimate. Email rich@tradewithufos.com and we'll send you a coupon so you can get that app for free. And that's forever, that's for life, okay? So the app runs on TradingView and you can have it for yourself. TradingView as well is a free platform, so you can have it just running and enjoy it if you liked it when you saw it on my slides, okay? But again, the subject for today was trading business, approaching trading as a business, and hopefully, you know, I did clarify your questions, I did open your mind, or at least I got you thinking about the importance of, apart from having this good methodology, and I'm for sure keep up that passion that we all have, but apart from passion and good methodology, also having a proper approach to trading with a business mindset where everything is planned from the top level, like you know, thinking of the company as a whole, and then the different divisions, plan for the Forex, plan for the futures, plan for the options, etc. And then finally getting into the trade plan. Anyway, everyone, super pleasure. I have exceeded, I believe, for 5 minutes the duration of this session, so I will need to conclude the session now. But again, super pleasure, and thanks as always to the FX Street community for having me here, and especially for you guys, for you all, for joining and your questions and also your kindness with me. See you soon, everyone. See you in a few weeks in the next one. Bye-bye. Take care.